When we think about, the end of a life, society gives us these very clear rituals, right?
Right, absolutely.
To kind of process the finality of it all. You
Right.
have the funeral, the eulogies, the burial. The book feels closed.
Yeah, you get that closure.
Exactly.
Hmm.
But then, like a week later, you walk out to the mailbox, you pull out an envelope, and it is a credit card statement addressed to the person who just passed away.
Which is just, it's a gut punch.
It really is. Suddenly, that period at the end of the sentence turns into this massive looming question mark.
Oh, yeah.
And you are here because you want to be prepared. You want that thorough knowledge to handle real-world problems without drowning in all that financial or legal jargon.
Because nobody wants to deal with jargon when they're grieving.
Right. So today we are pulling from a really highly illuminating piece. It's called Inheriting the Ledger, Managing Credit Card Debt After Death.
It's a great breakdown.
It really is. And our mission today is to demystify exactly what happens to that bill. Like, are you legally on the hook? Or is the credit card company just out of luck? Okay, let's unpack this.
Yeah, and that jarring reality of that mailbox moment, it's becoming incredibly common.
Really?
Oh, yeah, because the financial questions, they arrive right alongside the griefs now. The source material highlights this crucial macro context, basically. Borrowers today are carrying just record levels of household debt.
Right, everything is so expensive.
Exactly, and credit card balances remain persistently elevated across, like, all demographics.
Why?
I mean, we no longer live in that era where everyone pays off their house and, burns their credit cards before retirement.
Yeah, that's a total myth now.
Right. People are just living more expensive lives, and they frequently pass away before they can settle their ledgers.
It feels like you're trying to shut down a complex business while simultaneously navigating a massive emotional loss.
That is the perfect way to describe it.
Right. And the immediate visceral fear for anyone opening that mail, especially if it's a statement showing a massive balance, is personal liability.
Oh, for sure. Panic sets in.
The thought process is just, do I have to drain my own savings to pay off my dad's credit card?
Right. Well, the foundational rule in our legal system, which, applies to the vast majority of cases, provides a firewall against that exact fear.
Okay, a firewall. I like that.
Yeah, because a deceased person's credit card debt becomes the sole responsibility of their estate,
Okay.
not the surviving family members.
Yeah.
The law treats an individual and their estate as two completely distinct financial entities.
So they're totally separate.
Entirely.
Yeah.
Your personal bank account is legally shielded from their credit card issuer, regardless of how closely related you were.
Okay, that structural separation makes sense in theory, but I mean, when I hear the word estate, I don't know, it sounds like a sprawling mansion with a hedge maze or something.
Right. It sounds very fancy.
Yeah. So if my dad just had, like, a checking account, a 10-year-old sedan, and this massive credit card bill, how does this estate actually function to shield the family?
I know. The term is definitely loaded with unnecessary grandeur. But in legal and financial mechanics, an estate is simply a temporary legal container.
A container? Okay.
Exactly. The moment a person passes away, everything they owned, so their bank accounts, vehicles, real estate, personal property, and everything they owed, is immediately placed into this container.
Interesting.
Think of it like a financial airlock.
Oh, an airlock. Okay.
Yeah, it's a legally sealed chamber where all the assets and all the liabilities are just locked together.
And nothing gets out.
Right.
Yeah.
Nothing can pass through that airlock to the surviving family members until the pressure inside is equalized.
The pressure being the debts and the claims from creditors.
You got it.
Okay, so if the estate is this sealed airlock, who is actually inside operating the valves?
So that would be the executor. Or an administrator if there wasn't a will.
Right, okay.
Their primary job during the whole probate process is to manage that airlock. Creditors, like the credit card companies issuing those statements we talked about, will actively submit formal claims to the estate.
So they're knocking on the airlock door.
Exactly. They're knocking on the door saying, hey, we are owed this specific amount.
Well, wait, if a credit card company submits a claim to the executor, I imagine there is immense pressure to just, pay it to make the mail stop.
Oh, definitely. It's overwhelming.
Does the law require the executor to immediately transfer those funds the moment the claim arrives?
It absolutely does not. And actually, doing that can create severe legal jeopardy for the executor.
Really? Just for paying a bill?
Yeah, because probate is fundamentally a verification system. It's not just an automated payout system.
Oh, I see.
The executor has to scrutinize every single claim to ensure it's valid. Like, did the deceased actually owe this? Are there fraudulent charges?
That makes a lot of sense. You don't just blindly pay.
Right. And if the claim is verified as legitimate, and this is key, if the estate has sufficient funds, the credit card balance is eventually paid out of the assets inside that airlock.
Before anyone gets their inheritance.
Exactly, before any heirs receive a dime.
Mm-hmm.
So failing to pay the bill the day it arrives doesn't eliminate the debt, but the debt must wait its turn within this highly structured, methodical estate settlement process.
Dictated by state law, is it?
Exactly, governed entirely by state law.
Okay, here's where it gets really interesting, though.
Oh, yeah.
Because you mentioned paying the debt if the estate has sufficient funds.
Right.
What happens when we look inside that financial airlock and the math simply does not work?
Which happens a lot.
Right. Let's say there is a $20,000 credit card bill, but only $2,000 in the bank account.
So the legal term for that scenario is an insolvent estate.
Insolvent. Okay.
Yeah. The container simply does not hold enough assets to satisfy all the outstanding obligations. And according to the data in the source material, insolvent estates are remarkably frequent.
I can imagine.
When this happens, the law dictates a very strict repayment hierarchy. The executor cannot just pay whoever asks first, or, whoever complains the loudest.
Well, I would assume the government gets its cut before anyone else.
Always.
Where do credit card companies fall in that line?
You assumed correctly about the government. The IRS is always at the front of the line.
Naturally.
Yeah. Following taxes, the administrative expenses of running the estate, so things like court fees or the executor's legal counsel, those are prioritized.
Okay.
Then come secured debts.
Secured debts meaning loans tied to a physical asset, right?
Exactly.
So a mortgage is secured by the house, an auto loan by the car. If the estate doesn't pay, the lender just repossesses the physical collateral.
Right. They take the house or the car.
But credit card debt is unsecured. There's no collateral. I mean, they cannot repossess a tank of gas or a grocery haul from 2 months ago.
Exactly. And because credit card debt is unsecured, it falls to the very bottom of the repayment hierarchy.
The very bottom. Wow.
Yep. The creditors took on a higher risk by lending money without collateral, so they are the last to be compensated. The executor must distribute the limited funds down the line step by step.
Hold on, though. Credit card companies don't just walk away from money.
No, they don't.
They must have massive legal departments dedicated to squeezing every last drop out of an estate. So if the funds run out before the executor reaches the back of the line, what do the banks actually do?
Well, once the estate assets are completely exhausted, the remaining unsecured debt is typically written off by the creditor as a loss.
They just write it off.
Basically, yeah.
Yeah.
They cannot legally pierce the airlock and pursue the surviving family member's personal assets simply because of a blood relation.
Okay,
But, however, the reality of the collections process is much more aggressive than just quietly closing a file.
Right, because if they know the person is deceased and they know they can't pursue the family, how do they legally justify continuing to call or send letters?
What's fascinating here is how jet collectors navigate the Fair Debt Collection Practices Act during probate.
The FDCPA.
Exactly. Federal law restricts how they can communicate after a death, mainly to prevent the harassment of grieving families. But, and this is important, it does not ban communication entirely.
Oh, I see.
Yeah, collectors are permitted to contact the executor or, authorized individuals to seek payment from the estate. They aren't just blindly hoping for a check, though. They are probing.
Probing for what? Like hidden money?
Pretty much. They are probing to verify the estate's insolvency.
Ah.
Because the creditor doesn't actually know the airlock is empty until the executor legally proves it.
That makes sense. They want proof.
Right. The collectors are looking to uncover assets that might have bypassed the estate incorrectly, or to see if the deceased had a life insurance policy that mistakenly paid into the estate instead of a direct beneficiary.
Oh, wow.
So ignoring their communications is a massive mistake.
I would just want to throw it all in the trash, honestly.
Everyone does. But the source material warns that executors must engage with these collectors. They have to verify the legitimacy of their claims and provide the legal documentation proving the insolvency.
And if they don't?
If an executor simply throws the letters in the trash, the creditor can file legal motions that just drag out the probate process for years.
Ugh. That makes the executor's job sound like a strategic defense operation.
It really is.
So, okay, we've established that the general rule shields the family, the estate pays if it can, and the debt is written off if it cannot.
Right.
But the law is notoriously full of loopholes.
Always.
Let's dig into the exceptions. the times where the airlock fails and a grieving family member actually does end up legally responsible for the balance.
Yeah, so the text outlines three very specific exceptions where that corporate firewall just does not apply.
Okay.
The first involves surviving joint account holders.
No, we need to be careful with definitions here.
Yes, absolutely.
Because a lot of people add their teenagers to a credit card to help them build credit. Like, if I give my daughter a card with her name on it, but it is fundamentally my account, she's just an authorized user, right?
Exactly.
And the law does not hold authorized users responsible for the debt of the primary account holder after death.
No, it doesn't. That distinction is paramount.
Okay, good.
An authorized user is just someone allowed to spend the primary borrower's money.
Right.
A joint account holder, however, is completely different.
How so?
In a true joint account, both individuals applied for the credit line together.
Ah,
Yeah, the bank's underwriting department approved the loan based on the combined credit histories and incomes of both people.
so they're both equally on the hook from day one.
Exactly. Because both parties legally guaranteed the debt at the moment of application, the death of one account holder does not erase the legal obligation of the survivor.
Wow.
The debt was always fully yours, and it remains fully yours.
Okay, so that's the first exception. The second exception seems to operate on that exact same principle of a prior legal guarantee.
Yes, the cosigner exception.
Right.
If you co-signed a credit card, or maybe a personal loan for a family member, perhaps they had poor credit and needed your financial backing to secure the account, you acted as the guarantor.
You signed on the dotted line.
You did. You signed a contract stating that if they failed to pay for any reason whatsoever, you would assume the liability.
And death is the ultimate failure to pay.
Exactly. It immediately triggers that contractual promise. The creditor bypasses the estate entirely and comes directly to you.
That is just a harsh reality for someone who was likely just trying to do a favor for a relative.
It really is. It's tough.
So the first two exceptions involve signing a piece of paper and actively taking on the risk.
Right.
But the third exception listed in the source material seems entirely geographic, which is deeply unsettling.
Yes, it is.
It involves spouses living in community property states.
Yeah, and this is often the most shocking exception for surviving spouses.
I bet.
In the United States, certain states operate under community property laws.
Right.
And those laws dictate that most property and most debts acquired during the course of a marriage are owned equally by both spouses.
Wait. So if my spouse passes away and leaves behind a secret $10,000 credit card bill that I never signed for, never authorized, and never even knew existed,
Yep.
community property laws mean the bank can just take that out of my paycheck? How is that legally justified?
I know, it sounds wild. But the rationale behind community property laws originally emerged to protect non-working spouses.
Okay, how?
Well, the idea was that even if one spouse earned all the income and held all the assets in their name, the other spouse contributed equally to the marriage.
Sure, like staying home with kids or managing the house.
Exactly. And therefore, they deserved an equal half of the wealth. It prevents a non-working spouse from being left with nothing.
Okay, I see that. That's a good thing.
It is. But the double-edged sword of that protection is that you also share equally in the liabilities.
Oh, wow.
Yeah. So depending on the specific nuances of the state law, a surviving spouse might be held personally responsible for the unsecured credit card debt incurred by the deceased spouse during the marriage.
Entirely bypassing the estate shield.
Entirely bypassing.
That turns a theoretical legal concept into a terrifying financial landmine.
It really does.
I mean, knowing these rules in a vacuum is one thing, but actually executing them while you are grieving and dealing with creditors is a completely different challenge.
Oh, it's incredibly difficult.
So if a listener finds themselves acting as an executor and they are staring down a mountain of credit card bills and a seemingly empty bank account, how do they navigate this without stepping on a legal tripwire?
Well, the playbook provided in the source material emphasizes a very methodical approach.
Okay, what's step one?
The absolute first step is to freeze all outward cash flow and take a comprehensive inventory.
Makes sense. Don't pay anything yet.
Right. An executor must build a crystal clear balance sheet of every single asset and every single liability before writing a single check. You have to determine whether the estate is solvent or insolvent first.
Right, because if the executor panics, pays a $5,000 credit card bill just to stop the collection calls, and then realizes there isn't enough money left to pay the IRS or the funeral home, they've violated the repayment hierarchy.
Exactly. And by paying out of order, the executor can actually be held personally liable for the shortfall.
Wait, personally liable?
Yeah. The IRS will not simply forgive the tax debt because the executor made a mathematical error in favor of a credit card company.
Oh, wow.
So you must establish the size of the airlock and the volume of the claims first.
Okay. Once that inventory is complete, the text mentions a strategy that completely shifts the power dynamic.
It does.
It discusses negotiating with these massive financial institutions over the deceased person's debt.
Yeah, and negotiation is an incredibly potent tool for an executor managing an insolvent estate.
Which is surprising.
Right. But creditors possess sophisticated risk assessment models. When an executor provides undeniable legal proof that the estate is insolvent,
Meaning there's no money.
right, meaning the creditor is staring at the very real mathematical probability of receiving $0, the creditor's entire strategy changes.
A giant bank agreeing to take less than they owed feels counterintuitive until you look at the leverage.
Exactly.
If the bank knows they're at the back of the line and the money is gone, 30 cents on the dollar suddenly looks like a lifeline for them.
It's a purely pragmatic business calculation. Recovering a fraction of the balance is vastly preferable to a total write-off.
So you just call them up.
Basically, an executor can reach out, present the inventory, and offer a settlement. In many cases, these discussions are highly productive and allow the estate to close much faster.
Okay, but what about the surviving spouses caught in those exceptions we discussed?
Oh, right.
The ones who do inherit the debt through a joint account or a community property law and are now facing insurmountable financial pressure on top of their grief.
The text strongly advises those individuals to explore structural debt relief solutions, rather than simply draining their retirement accounts just to stay afloat.
Like what kind of solutions?
Depending on the severity of the inherited debt and, their personal financial situation, options like debt settlement, formal debt consolidation, or engaging with accredited credit counseling agencies can restructure the obligations into something manageable.
Okay, so there are options.
There are. But the most critical directive the source material offers, and this applies to both executors and surviving spouses, is to seek professional counsel.
Because the variations in state probate laws, the complexities of community property statutes, and just the aggressive tactics of debt collectors, those are not things you want to learn through trial and error.
Definitely not. A single mistake in interpreting a state statute or handling a creditor's claim can cost an executor or a spouse thousands of dollars in personal liability.
Yeah, you need an expert.
Consulting an estate attorney or a certified financial professional provides a necessary buffer. They know how to silence the collection calls legally.
Which is a relief in itself.
Huge relief.
Yeah.
They know the exact hierarchy of claims in your specific jurisdiction, and they handle the negotiations. It allows the family to focus on the actual process of mourning rather than administrative warfare.
Administrative warfare, that is so accurate.
Yeah.
So what does this all mean? Let's bring this right back to you, the listener.
Right.
Why should you care about the mechanics of probate and unsecured debt today, especially if your family is perfectly healthy?
Why does it matter?
You care because understanding the architecture of this system before a crisis hits is how you build a fortress around your family's financial future.
Absolutely.
The bottom line is that the system is designed to go after the estate, not the surviving family.
The airlock.
Right. Unless you actively signed your name to the dotted line as a joint holder or a cosigner, or you reside in a state with community property laws, you do not inherit your loved one's credit card debt.
It's just not yours.
If their estate cannot cover the bill, the debt is written off. You are not legally required to empty your child's college fund to settle an unsecured ledger.
And that structural reality provides an immense amount of necessary comfort.
It really does.
But if we connect this to the bigger picture,
Oh, here we go.
it reveals a fascinating underlying economic truth.
Okay, lay it on us.
We established earlier that household debt is at record highs, and millions of estates are insolvent every year.
Right.
That means credit card companies are routinely absorbing massive, multi-million-dollar write-offs when borrowers pass away.
And banks are not charities.
No, they are not.
They do not just absorb those losses and take the hit to their profit margins.
Exactly. This raises an important question. How do you think those financial institutions factor the inevitability of human mortality into their business model?
Oh, wow. They price it in.
They price that risk directly into the system. The everyday interest rates, the annual percentage rates, the late fees that every single living borrower pays, They are calculated to subsidize the losses incurred by those who die with unpaid balances.
It is an invisible death tax built into the very fabric of our everyday credit.
That's exactly what it is.
Every time you look at a 24% interest rate on a statement, you are looking at a mathematical model that has priced in the cost of insolvency.
It makes you look at that envelope differently.
It really does. That brings a completely different perspective to that envelope in the mailbox. It is not just a bill. It is a calculated piece of a vast, unsentimental financial machine.
Perfectly said.
Well, thank you for exploring the mechanics of the system with us. Protect your airlocks, read the fine print on those joint accounts, and we will catch you on the next deep dive.